Now that we understand how supply and demand zones are created, how we map them, and the different ways that we can map them, the next most important thing is to understand how price is returning to the zone that we are looking to trade and what that may imply for our trade in question. Because as I stated in the previous videos, our job is to identify a supply or demand zone being created, map out that zone, and then patiently wait for price to return to that zone. Now the next step is seeing how does price actually return to that zone and what does that mean to me? So there's three different ways that price is going to return to a potential supply or demand zone. We have a rounded return, a corrective return, or a V reversal return. And each one of them has their pros and their cons, and we'll go through those right now. Again, we're looking at it from the lens of range created supply and demand and pivot created supply and demand. But as we spoke about in the previous section, was even if it is range created supply or demand, we can also map out our supply and demand zone using the pivot theory, or refining to a bullish candle before that down move or bearish candle before that up move. So when we're looking at that and we're just focusing on range created supply and demand, however you map the supply zone in question is up to you at this point, but now we're focusing on how does price return. If we're looking at the rounded return, what we end up seeing is price very slowly rounding out into that supply zone. And more often than not, what we see is liquidity being built on the downside and on the slope or return back in. Now we'll touch on liquidity in a later section, but just keep that in mind for as we progress to the next sections. We can see that again in the demand section, where we have this rounded return where price slowly rounds back into the demand zone. When you're looking at it from an order flow perspective, basically what is happening is there isn't a lot of demand at these particular levels or supply at these particular levels to push price. So basically what's happening after we've had that rapid expansion to the downside for a supply zone, there isn't any more supply to push price further down. And what needs to happen is demand needs to step into the market. But at this particular price point, there's a little bit of confusion in the market, and price is filling orders, rebalancing the imbalance between supply and demand. And once demand has caught up with the amount of supply that's just entered the market, price then slowly rounds back into that supply zone, which is where we would look for our entry. The same thing can be said about demand. There was a rapid injection of demand into the market that pushed price higher, and price is now rebalancing the mix between supply and demand, and prices slowly and rounding back into the demand zone, and we would be looking for entry. This is a very high probability that the zone will hold, and this is a really great way to measure your return back into a supply or demand zone, looking for that rounded return. The next one that we would be interested in is the corrective return, and that's basically once price creates a supply zone, we see that expansion out. We're waiting for price to return back to our supply zone. You see price is moving to the upside, moving to the downside, moving to the upside, and it's conceptually it looks like it's struggling to move up and down, but we are slowly moving to the upside and back into this supply zone. You can see we create a high, we break that high, but then we're immediately moving back to the downside. And if we're looking at it from a basis of supply and demand on a more fractal level, once we create this up move, we create a demand zone, price taps into that demand zone, price moves to the upside, creates a new demand zone, we tap back in, we create a new demand zone. Once price moves to the upside, price returns back to that demand zone. And by that point, all of this demand has been consumed so that price can freely move to the downside. And what we can see on the flip side for demand is as price falls, we create a supply zone. Price taps into that supply zone, moves back to the downside. We create another supply zone. Price moves back into that supply zone, moves back to the downside, creates another supply zone that is tapped into again. All of the supply is absorbed so that price can freely move to the upside. And what we can see conceptually as well for the rounded return, just going back to that, touching on that, we don't really see that absorption of supply or absorption of demand as it returns back to the level. But the fact that it's rounding instead of correcting really is showcasing that there isn't a whole lot of, in this case, supply being created. So there's not really much existing here that we'd be looking at. If we're looking at support and resistance type traders, they would be looking for some sort of bounce at these levels, which is why price would be magnetized to move to the downside or move to the upside for demand. Now, if we move to the final return back to the zone, we have a V reversal type return. And this is basically where price creates a supply zone. We break to the downside and price basically immediately reverses back into it. We create that V price action. These are a very risky play in terms of trying to trade the sell on the supply zone. What this is implying is price moved to the downside rapidly. It was met with a fair amount of demand that pushed price up extremely rapidly. And basically what that means is it just shows a very strong reversal in price. More often than not, what that's going to imply is that price is not going to hold that supply level. What you may see is price move to the downside and then begin to move back up into the upside. And then the cycle would begin where you might actually be interested in looking for demand zones that were created on this V-type reversal. And it's the same premise and concept for demand zones. We get that aggressive move back in, basically it creates a V in price. It absorbs all of the demand there. But what we'd be looking for more than likely is a supply zone to be created for price to move to the downside. It's not to say that the V returns don't work, but statistically comparing them against these two, these are much higher probability because it's building liquidity or reason for price to continue, whereas this shows a change in order flow from supply to potentially demand. Because as you can see, just looking at these conceptually, you get this slow creeping move back in, slow creeping move back in. This one is a very rapid return back into that supply zone, which shows that there is not really an imbalance in supply and demand favoring supply. This is showing that supply and demand are very much balanced at this point, and it's better to wait for some sort of other criteria to look for a trade if you're looking at it in that respect. And the same can be said for pivot supply and pivot demand, where we have our zones created via a pivot, and we're looking for, again, that rounded return back into that supply zone or that rounded return back into the demand zone. These will always be, in my opinion, your highest probability setups, as well as the corrective return into a pivot supply or pivot demand. And then again, we have the pivot V reversal return, which is aggressive. We see basically that very quick reversal back into the supply zone. Generally speaking, these models don't tend to work out this return, and if you do tend to find this, it's better to stay out of the trade and look for something a little bit differently. Or if you do get some sort of reaction that does follow through, you might be able to trade a newly created pivot that has maybe a better return into it, a rounded return or a corrective return. And one final thing that I wanted to touch on in regards to return to zone considerations, what you'll often see on the zones that play out the most, and this may sound a little bit confusing initially because I had just said that the V reversal or that aggressive move back into a supply or demand zone tends to be the lower probability, is if we're looking at, say, rounded return or corrective return, if that last leg into the supply or demand zone is relatively impulsive, we see a move that almost puts you off. So a larger move into supply or a larger move into demand. Often what that ends up being is an even higher probability that the move is going to be more aggressive to the downside. And it's really just on that last leg. Now, if the whole move is aggressive in, it's not great and it's low probability. But if that last little re-entry into the zone is high momentum or larger volatility candles, that often means that price is gearing up for a large move to the downside. What can be said is that there's a lot of momentum being pumped into the markets to get ready to push it down further. Just one final consideration to be thinking about when you're having that return to zone considerations is focus on your rounded and your corrective return to zones. And be mindful that the V reversals tend to be aggressive and don't play out statistically. Again, you can look to trade them, but be more cautious. And then also consider that last leg that's into a supply or demand zone ends up being what this would be called as a sucker's rally into it. This entices buyers to continue up and look to, in theory, break this range. But because we're entering a supply zone, we'd be pushing down, and that's why we get such a large momentous move to the downside. The same is said where we get this sucker's rally to the downside. A lot of people look to jump in because what they see on their chart when they're looking, they just see price moving higher highs and higher lows. And they're just looking for this to be a higher high and price to continue moving to the upside. Or in this case, we're seeing lower lows and lower highs. So when we put in this lowest low, we're looking to see price continue to the downside. So this large injection into the zone is what propels the momentum faster and harder to the downside. And that pretty much sums up the return to zone considerations. It's definitely something to be very mindful of because, as I've stressed in the previous videos, is that we are waiting for price to return to these zones, and how it returns to that zone is incredibly important. So it's important how the zone is created and how you're looking to map that zone, but it's even more important to consider how is price actually returning to the zone that I'm looking to enter on. When you're able to frame that up, understand how it's returning to that zone, you can build and frame up very high probability trades, or even avoid trades that are inherently lower probability because of how they enter that zone.